Okay, we'll go ahead and get started. Good afternoon, everyone, and welcome to the CalSTRS and CalPERS webinar. My name is Tori Sierra, and I'll be kicking off our time together today. My other half is Alex Sierra, certified financial planner who specializes in retirement planning for teachers. And over the next 45 minutes, we'll cover the resources that we have for you for retirement, how to access them, the ins and outs of the CalSTRS and CalPERS pensions, and how to maximize them. We'll wrap with a quick Q&A session at the end. So write down your questions as they come up and leave them for the end of our presentation today. Then we'll launch into a poll to get feedback on follow-up and then on the other webinars that we'll be hosting for the remainder of the year. Before we begin, wanted to share our website where you can access all of our resources. Here you can schedule a meeting, read our blog, watch videos, and visit our teacher resources page, as well as contact us. You can see our URL at the bottom there. Here you can also schedule a meeting with Alex. With this button down here, you can schedule a virtual meeting with him or in person if you prefer that. And then our YouTube page, we post videos too on topics relevant to our clients. And then specifically, we have a series dedicated to teachers, breaking down terms, concepts, and strategies relevant to you all. And without further ado, I'll pass this over to Alex to begin the CalSTRS and CalPERS focused portion of this webinar, and I'll see you on the other side.
Awesome. Thanks, Tori. And thank you, everybody, for taking the time to be here tonight. I know we're in the middle of back to school season, which can be very busy. So appreciate you taking some time out of your busy schedule to learn a little bit more about your pension system. So like Tori mentioned, today we're going to be covering the two largest pension systems in the state of California: the California Public Employees Retirement System, or CalPERS for short, and the California State Teachers Retirement System, or CalSTRS for short. Typically, teachers will be the ones who have the CalSTRS pension, and other school employees, like classified employees, are going to be the ones who have the CalPERS pension, though I've seen teachers with the CalPERS pension as well. While there's some key differences between the two pension systems, I would say there's even more similarities between the two systems. They're very, very similar. The first big similarity is that they're both pension systems. So what a pension system means is that employees, while working, are making contributions into the pension system. These contributions go into a large professionally managed pool of money. And then later down the road, when the teachers and employees retire, they begin to receive distributions from that pool of money, and that is their pension payment in retirement. So that's kind of big picture how a pension plan works. Again, today we're going to be going kind of like a high-level overview of the two pension systems, but I would encourage you to schedule a virtual meeting with me if you want me to look at your specific numbers or how it applies to your specific situation. All right, so today we're going to be explaining some of the key areas of your retirement benefits. So that's going to include eligibility for CalSTRS and CalPERS, estimating your pension benefit, so showing you how to calculate an estimate, talking about your survivor benefit options, and then looking at how your pension might affect Social Security. And then we'll lastly review some of the supplemental retirement programs that are available when CalSTRS, CalPERS, or Social Security are not enough on their own. So we'll start by answering the question, who is eligible for retirement? So this is the time when you are considered vested in the pension and therefore entitled to at least some benefit. It's important to note that just because you are eligible for retirement, that doesn't necessarily mean it's the right time to retire. There's a lot more that goes into it, but these are kind of like the earliest ages you can retire. For CalPERS, it's going to be age 50 with at least 5 years of service credits for those hired before 2013. For those hired after 2013, it's going to be age 52 with at least 5 years of service. For CalSTRS, normal retirement age is going to be age 50, but you're going to have 30 years of service to be able to do that. or age 55, which is more typical, with at least 5 years of service credits. And that's all if you were hired pre-2013. For those hired after 2013, the normal retirement age starts at 55, and you need at least 5 years of service credit. There's some special situations that the pension can make for like exceptions, but not typically. So typically you'll be eligible once you hit these requirements. Next, we'll look at how to estimate your contributions. So a lot of my clients don't even realize or don't really think much about how much they're contributing to the pension, since it comes automatically and you don't really have a choice, but it is pretty substantial. In addition to your contribution that you make, typically your district will also be matching you on contributions into the pension system. So we hear about how private companies, they have 401ks with a match. This is essentially where your district provides your matches. You add to CalSTRS or CalPERS, and your employer also adds to CalSTRS or CalPERS. For CalPERS, the employees or the members contribute 7% of their pay. So for example, if your annual income was $100,000, you would contribute $7,000 throughout the year. For CalSTRS, you can see that the percentage has changed throughout the years. However, it's currently at 10.25%. So for example, if you make $100,000, your contribution to the CalSTRS pension would be $10,250. So just remember, you are probably, without even thinking about it, saving pretty significantly for retirement. We hear all the time, you should be saving 10% of your income at least. Teachers are kind of forced into it because they're adding 10.25% of their pay. So you are doing some savings. All right, so now we'll look into how to calculate your defined benefit payout. So if you're taking notes, this would be the one equation, the one thing that I'd be writing down is the equation that's on the slide here. I'd say that's one of the most important takeaways from the presentation. To calculate your pension, it's going to be your pension benefit. It's going to be the same for CalSTRS and CalPERS. They use the same formula. And that formula is a simple three-part equation, which is service credits times age factor, sometimes called the benefit factor, and times final compensation. In order to calculate your benefit, all you have to do is find those three factors and multiply them all together. So to understand the equation a little bit better, we're going to go through an explanation of each of those factors, and we'll start with service credits here. So in general, for service credits, one full-time year of working is going to be one service credit. If you've worked part-time, you can sometimes receive partial service credit, so look out for that. You can't, even if you work summer school, coaching, extra time, you cannot earn any more than one service credit per year. When you retire, if you have significant unused sick leave, you can also turn that in for additional service credit. So if you have a whole year's worth of sick leave credit, you can typically turn that in for a whole year's worth of service credit. So keep that in mind before, taking a super long vacation right before you retire. Could potentially turn those unused sick days to additional service credits to make your pension a little bit bigger. Back in the day, you used to be able to use your savings to buy additional service credits. However, now you can only do that if you've at some point cashed out of the pension and are buying back in. So that, just being able to buy them on the market has gone away. But in certain cases where people are coming back to CalSTRS or coming back to CalPERS, they may have the opportunity to purchase back their old service credits. You can pretty easily estimate the amount of service credits you have if you know how many years you've worked. However, the only place for you to know for sure exactly how many service credits you've been credited with is to look at your statement. So speaking of statements, this slide here, taking a look at your statement. For both of your systems, for CalSTRS and CalPERS, you should receive a copy of your statement at least once per year, but you can at any point in time go online to download the most recent copy of your statement. For CalPERS, all you would do is just go to My CalPERS, log in and download your most recent statement, and you'll be able to locate your amount of service credits there. Same thing for CalSTRS, just go to My CalSTRS, log in, and download your most recent statement and look for your service credits there. This is really important because I've had many situations where my clients think they have a certain amount of service credits, but then once they go in and look at their statement, they actually have more or less than they originally thought. So if you haven't checked your amount of service credits in a while, I would check that. CalSTRS and CalPERS, while it doesn't happen often, they do make mistakes. So you want to make sure that everything looks correct there. On the CalSTRS side of things, on the statement is also going to be the best way or the best place for you to check the balance of your defined benefit supplement, which is another additional account that's part of your pension. And we'll discuss that a little bit later in the presentation. All right, so service credit was the first part of the equation. Next, we're going to look at age factor, which is the second part of the equation. So these age factor tables are from the CalSTRS and CalPERS handbooks, respectively. So if you want these, you can obviously request these tables from us, but you can also just look at your most recent pension handbook that you can locate online, and they'll have these tables in there as well. The age factor table is going to be different depending on when you retired. So there's going to be one age factor table for those hired pre-2013, and that's what's pictured on the screen right now. And then on the next slide, you'll see that there's another age factor table for those hired after 2013. And unfortunately, those hired after 2013 are going to have to work just a little bit longer to get the same benefits that those who were hired pre-2013 will be entitled to. So to understand a little bit better, we'll go through these examples at the bottom of the slide here. So in this example, this person is age 60, has 28 years of service, and their final compensation is $100,000. So to calculate their benefit, you would take service credits, 28, times the age factor, and then to locate the age factor, you would go to the age that you plan on retiring in. And in this case, it's 60, and the age factor there is 2.31. So I would multiply 28 times 2.31% times 100,000, which is my final compensation, which means I'd be entitled to a benefit of a little over 64,000 per year, or $5,390 per month. So that is CalPERS. On the CalSTRS side, same example. So age 60, 28 years of service, final compensation 100,000. You would take 28, and in this case, you would put in 2% because next to age 60 on the CalSTRS age factor table is 2% times 100,000, which would equal a total compensation of 56,000 or $4,667 per month. So just pause there to look. This is pretty much the same person retiring at the same time. You'll notice that the CalPERS pension for that same person is a little bit bigger of a payout. So just interesting to notice that the CalPERS pension is just slightly more powerful there. Same chart here. This is now the chart for those hired after 2013. And you'll just see what I mentioned earlier. Well, they'll have to work a little bit longer to get the same benefits. So going through the same example here, age 60, 28 years of service, final compensation 100,000. You would take 28. You would multiply it by the age factor now of 1.8%, which is quite a bit different than the pre-2013 age factor, but you just go to age 60, the age factor there, 1.8%, multiply by $100,000, comes out to a little bit over $50,000 per year, or about $4,200 a month. So a few $100s a month less than that same person if they were hired pre-2013. On the CalSTRS, same example, 28 service credits. Now we would use an age factor of 1.76% because that's what's on the age factor table, times 100,000 comes out to about 49,000 a year, or $4,107 per month. So still less on the CalSTRS side, but main takeaway here is post-2013 has even smaller estimates for CalPERS and CalSTRS than those hired pre-2013. Okay, so we've talked about service credits and we've talked about age factor, which are the first two parts of the equation. The third and final factor to discuss is the final compensation. Note that final compensation does not always mean your final compensation, though it often is, because typically we usually make more and more each year as our career goes on. It's not necessarily the case. So sometimes the term final compensation can be a little bit misleading. To specifically calculate what your final compensation is, for CalPERS, it's going to be pretty easy. You're just going to take your highest consecutive 12-month compensation. So whatever your highest annual pay was, that's what you plug into final compensation. For CalSTRS, it's going to depend a little bit on how long you've worked when you decide to retire. So if you retire and you have over 25 years of service, you're just going to take your highest annual salary. So no matter when that is, typically your last year, but not always, you would take your highest salary and plug it into the equation. If you have less than 25 years of service credits, you'll instead have to take the average of your highest 3 consecutive years. So typically that will result in a slightly smaller final compensation. One other note here, and this is going to be something only for CalSTRS members and only for CalSTRS members hired before 2013. And that's something called the career factor. And the career factor essentially says that once you hit 30 years of service credits, you can get an additional 0.2% added to your age factor. With that in mind, the maximum age factor still is 2.4%. So no matter what, can't go above that. But looking at this example here, so in this case, the member is 62 years old and now has 30 years of service. So, hitting that career factor mark and final compensation of 100,000. So to calculate their benefit, you would take their amount of service credits, which is 30, multiply it by 2.4%. And the reason we came up with that is we would normally at age 62 use 2.27%. But because we have 30 years of service when retiring, we'll add the career factor, which means that would normally take us to 2.47%. However, the max is 2.4%. So we hit the max there. So that's why we're plugging in the max on the age factor side of things. Multiply that by 100,000, comes out to a benefit of about 72,000 a year or 6,000 per month. All right, so we've gone through all of the factors of the equation. And so you could already right now on a piece of paper estimate your pension payout. All you have to do is take the amount of service credits you have, multiply it by the age factor, and then multiply that by the final compensation. And that will give you your annual estimate for what you can expect from your pension. If you divide that by 12, that will give you your monthly benefit when it comes to your pension. So now that we've looked at that, we're going to move on to discussing your survivor benefit options. So I would say, other than deciding when to retire, deciding which survivor benefit option you're going to take is probably going to be the most important decision you make when you retire. And the reason for that is that once you retire and you choose a survivor benefit option, you can't change it. So the decision is final. So far, the equation that we've reviewed is going to be the one that calculates the unmodified allowance for CalPERS. So that's on the top of the slide there. This unmodified allowance is the option that pays your benefit out to you and you only for the rest of your life. If you pass away, nothing would continue on to your survivors. So it's the most for you, but none for your survivors. If you're single when you're retiring, it's going to be a no-brainer. You're pretty much almost always going to choose that option since it gives you the highest benefit. However, if you're married or have other dependents, you might wish for your payment to continue to your spouse, even if you were to pass away early. And to kind of defend against that potential scenario, the pension systems do offer these survivor benefit options. In general, when it comes to the survivor benefit options, the more protection that's provided to your spouse, the smaller a benefit you will see while you're alive. So for CalPERS, we'll go through CalSTRS in a second, but for CalPERS, the most common options are what are called option 1, option 2, and option 3. Very, very creative names by CalPERS. Option 1 is a lump sum payment of the remaining member contributions payable to the beneficiary after death. So basically what this means is if you take option one and you pass away, whatever is left over as a lump sum of your pension would go to your beneficiary. So that's one option. Option number two is going to be the 100% protection option. So this is where your beneficiary would receive 100% of your monthly benefit after you pass away. So you're fully protecting your pension. Option number three is the 50% protection option. So this is where your beneficiary would receive 50% of the monthly benefit after you pass away. So we'll go through an example to kind of hammer this home. So in this example, this member, same member we've been looking at the whole time, age 60, 28 years of service, $100,000 final compensation. Our calculation says that their unmodified allowance would come out to $5,390 per month. If instead they wanted to look at one of these survivor benefit options, they have option 1, 2, and 3. Option 1, again, the lump sum option, you as a retiree would only get $5,230 per month, right? So about $160 less per month that you would get. But if God forbid something happened, your beneficiary would receive that lump sum. Option 2, the 100% option, you would only receive $4,755 per month. So that's over $500 per month less that you would receive. But if something happened, your beneficiary would continue to receive that $4,755 per month. Option 3, the 50% option, you would get $5,052 per month. So you could see it's a little bit less of a deduction for that one. But if you passed away, your survivor would only get $2,526 per month. So that's how it looks on the CalPERS side of things. On the CalSTRS side of things, the concepts remain the same. So when we do all that work to calculate your estimate, what we're calculating is going to be your member-only benefit. You know, that's the same as the unmodified allowance, just different name for now CalSTRS. So this is the payment that goes to you and you only for the rest of your life. Like CalPERS, CalSTRS also provides survivor benefit options, and they call them the 100% option, the 75% option, and the 50% option. Also very creative names from CalSTRS. So to understand these options, we'll work through this example again. So same members, age 60, 28 years of service, $100,000 compensation. The member-only benefit comes out to $4,667 per month. If you were to instead take the 100% option, you would only receive $4,150 per month. So another $500 per month deduction that you see by taking that protection. If you pass away, your spouse would continue to receive that $4,150. They also have the 75% option and the 50% option as well. And the main takeaways there are that you get deducted a little bit less, but then only 75% of the pay continues to your spouse, or if the 50% option, only 50% of the pay continues to your spouse. Before making your final decision on which option to take, like I said, this is the second most important decision when it comes to your retirement. It's very important to weigh the benefits and costs of taking one of these survivor benefit options. So if you choose one of these options, say the 100% option on CalSTRS, essentially what you're doing is you're purchasing insurance on your pension through the state, right? Basically about a $500 per month cost so that I have protection for my pension. Now, one thing is that the state has to offer this benefit to everyone, and they have to offer it to everyone at the same rate, regardless of health or anything like that. So they have to offer the same insurance rate for somebody who maybe has a terminal illness as they would to somebody who maybe still runs marathons, etc. So oftentimes, if you're healthy, it could be cheaper and potentially more efficient to apply for private life insurance and utilize that to protect your pension instead of being forced to take one of these survivor benefit options. So that allows you to take the member-only option, get the most for you, and then you can just rely on your life insurance to potentially protect your pension. So again, only works for some people. You have to be healthy. But that's something that our team can help you discuss to see if that's feasible. The concept or the name of the concept is pension maximization or pension max. So if you're having a consultation with myself, just mention one of those terms and I can help you discuss your survivor benefit options there. Our company also has the ability to request quotes from pretty much any life insurance company on the market. So we can help, pair you with the best quotes for you as well. All right, so inflation adjustment. So once you start getting your CalSTRS or CalPERS benefit, your income won't just stay flat. It will continue to grow over time to help keep up with inflation. So both offer inflation adjustments. Some call these COLAs or cost of living adjustments. On the CalPERS side of things, they offer a maximum of 2% compounding COLA, and they base it off of the CPI or Consumer Price Index, and their goal is to maintain at least 75% of purchasing power. On the CalSTRS side, they do a non-compounding 2%, and their goal is to maintain at least 85% of their purchasing power there. Now you'll see there, they have the defined benefit supplement. This is another cash value account that could help you battle the effects of inflation. The defined benefit supplement account is something, again, only for CalSTRS member, and it's a cash value account that you cannot access until you retire. If you've worked for the district for a long time, like over 10 years or so, or maybe you've worked a lot of extra time, like summer school, coaching, you might have a significant amount of money in your defined benefit supplement. And a reminder, your statement is going to be the best place to check how much you have in your defined benefit supplement. Once you reach retirement, you get to decide what you're going to do with it. And your three options are essentially to annuitize, which means turn it into a monthly payment to add on to your CalSTRS payment. You could cash it out, but you got to watch out for the tax consequences there. Or you could do a rollover to an IRA and combine it with all of your other retirement accounts. And in my experience, that third option is the most common choice amongst the teachers that I help retire. So if you need help weighing in your defined benefit supplement options, that's something that I can definitely help you discuss. All right, so we're going to discuss how CalSTRS and CalPERS affect your Social Security benefit. So for the most part, if you're contributing to CalPERS and you work for the school district, you are also contributing to Social Security. So given that, you're likely going to be eligible for Social Security. You just have to meet the normal qualifications, which is 40 quarters with Social Security or 10 full-time years of work. So as long as you meet those minimum standards, you should be eligible for a CalPERS payment. If you're contributing to, or a Social Security payment, excuse me. If you're contributing to CalSTRS, you are not contributing to Social Security. So that means that for the most part, you're not going to be entitled to a Social Security payment. However, if you've contributed to Social Security in the past, you might be impacted by the WEP or the windfall elimination provision. And then also, if you have a spouse that's going to be getting Social Security, you also might be impacted by the GPO or government pension offset when it comes to your spousal benefit or survivor benefit. So we'll go right now into the windfall elimination provision and the GPO. So again, this is windfall elimination provision or WEP is going to apply if you've contributed to Social Security in the past and expect to receive money from both Social Security and CalSTRS. The key to knowing if the windfall elimination provision will affect you is the number of qualified years that you've added to Social Security. So that's really the number that you need to know. And you can go onto Social Security's website and look at your progress report there and see how many eligible years you have. If you have less than 20 eligible years, you're subject to the maximum windfall elimination provision penalty, which right now is $558. So that's going up also each year to keep up with inflation. But again, right now, the max penalty is $558. If you have 30 or more years of eligible contributions to Social Security, you are not subject to the windfall elimination provision penalty at all. right? And then the closer you get from 20 years to 30 years, the smaller your penalty becomes. So we'll go through a quick example here. So Sonia Garcia's Social Security benefit at full retirement age is $1,000 per month. So that's how much she would normally get from Social Security. But she will also be receiving CalSTRS. So she'll be impacted by the windfall elimination provision. Sonia, in this case, has 15 years of substantial earnings with Social Security. So because she has 15 years, that's less than 20 years, which means she is going to be subject to the maximum penalty. So we take her $1,000 per month that she would normally be entitled to, subtract the maximum penalty, which means that she would be entitled to $442 per month from Social Security. So better than nothing, but on her Social Security estimates, it's probably saying $1,000 per month. So you just have to remember, as a teacher subject to windfall, you may have to, subtract the penalty in your mind when you're doing your planning. All right, so we're going to go through government pension offset briefly, but in order to kind of set that up, I think it's important to do a brief explanation of how spousal benefits work for Social Security. So essentially, your spousal benefit is going to be equal to half of the primary worker's Social Security benefit if started at full retirement age. So in this case, if Mary is the primary worker, Mary's benefit at full retirement age is $2,000 a month. Jacob's benefit at full retirement is only $800 a month. Instead of taking his benefit, Jacob would actually be eligible for Mary's spousal benefit, which comes out to $1,000 per month. So normally, in this case, Jacob would take that $1,000 a month spousal benefit. And again, that's 50% of Mary's benefit. However, with the government pension offset, you essentially need to subtract 2/3 of your pension benefit from the spousal benefit you would otherwise be entitled to. So that 2/3 rule would be the main thing that I remember if I were you when it comes to the government pension offset. Again, take 2/3 of your pension and subtract that from the spousal benefit you would normally be entitled to. So in this case, Mary and Jacob, again, both are 66. Mary's Social Security benefit is $2,000 per month, like we discussed. The spousal benefit is half of the higher income spouse's benefit at full retirement age, or $1,000 per month. So Jacob would normally be entitled to $1,000 per month. However, in this case, Jacob is also getting a pension from a non-Social Security employer like CalSTRS, and his CalSTRS pension is $3,000 per month. So to calculate his spousal benefit, you would take 2/3 of the $3,000, right? That's 2/3 of his pension benefit, which comes out to $2,000, and you would subtract that from the spousal benefit he would otherwise be entitled to. So 1,000 minus 2,000 equals negative $1,000. So luckily, Social Security won't make you send them $1,000 per month if this is how it works out. But in this case, Jacob would not be eligible for a spousal benefit or survivor benefit at all. So that's a little bit about the government pension offset. For most people, your pension and Social Security alone aren't going to be enough to fully fund your retirement. I'd say this is especially true in those that live in high cost of living states, like all of you in California. So to save additionally for retirement and kind of fill in the gap, they do offer different supplemental retirement programs. Most common one at every school district is going to be the 403B program. This is going to be a pre-tax, tax-deferred retirement, and you can typically choose from a variety of different providers at your district. Most districts will also have a 457B program, but you only usually have one investment provider to choose from for the 457. In addition, you might consider starting up individual retirement accounts like a traditional IRA or a Roth IRA. Traditional IRAs are pre-tax, tax-deferred retirement accounts, and Roth IRAs are after-tax retirement accounts that grow tax-free. These days, most districts are also offering a Roth 403B plan. So if you prefer the Roth or after-tax style of savings where you put money into the account, you don't necessarily get a tax deduction, but Fast forward to retirement, you can pull money from that account 100% tax-free. If you prefer that style of saving, check out it to see if your district is offering the Roth 403b plan. That could be a really good option for you. If you already have a supplemental retirement account like a 403b or an IRA, I can help you review your investment portfolio and help make sure that you're set up for the long run. And if you still haven't started up a supplemental retirement account and you need help deciding, if it's better to do a Roth 403b, traditional 403b, or a Roth IRA, I can help you walk through your options and decide which one makes the most sense for you. Other areas that we can help in. So we can be a resource in several different ways, but the first one and big one is going to be that we can help you run your CalSTRS and CalPERS payouts. So we have access to sophisticated software that can actually show you what your estimates are at any age, right? And so you can see in this example here, this shows somebody's estimates at age 60, age 61, age 62, so on and so forth, all the way through age 70. This can be key in helping you to decide when the right time to retire is going to be. We can also help you look at your survivor benefit options. Again, like I mentioned, other than deciding when to retire, survivor benefit options is the second most important decision you'll make. So our team can actually help you review your survivor benefit options and then the cost associated with each option. So we can kind of see what the cost for the 100% might be, what the cost for the 50% might be, help you decide which option makes the most sense. And then we can also request quotes from the private life insurance market to compare to the survivor benefit options to see if that alternative route might make more sense for you. And then lastly, we can also help you with your portfolios. We have a sophisticated software called Riskalyze by Nitrogen that we use to determine your personalized risk number. And this is a number that represents how much risk that you want inside of your portfolio. And then we can also run that same analysis on your current portfolios to see what the risk number associated with those portfolios are. And really what we're looking for here is, does the amount of risk that you want line up with the amount of risk that your portfolio has? So that's an analysis that we can easily run for you if you set an initial consultation with myself. So that's it for me for today. Keep your questions. We're coming up to question time, but Tori's going to wrap it up now with a couple final thoughts.
Yeah, thank you so much, Alex. That was great information. Reminder to visit our website for all of our resources. And you can see the website there at the bottom. Whoops. And the best resource on our website is our schedule a meeting page, where you can schedule a meeting with Alex by clicking this button here. You can meet with him virtually, or you can meet with him in person if you want to come to the office. And we have guided many, many teachers throughout the years to and through successful retirements, and we want to help you too. So I'll launch a poll that will give you an opportunity to provide feedback on our webinar.